Hello, welcome to this week's Market Carver. I'm Andrew Thrasher, Portfolio Manager for Financial Enhancement Group, joined by Zach Unger, Senior Analyst. We have two topics to discuss with this week's Market Carver that we covered in our weekly allocation meeting with our advisors. The first one is looking at AI adoption by different companies. We spend a lot of time talking about the importance to AI and those types of stocks of the market, and now we're seeing some of the impact, or at least potential impact, to the underlying companies using this new technology. Then Zach's going to dive in to some of what's going on in the M&A space and some of the mega deals that are taking place right now. First, we have a chart to share with you. It has two different parts to it. The first one is looking at, as we come out of the Q3 earnings season, looking at the number of times or the number of companies that are referencing AI adoption. We are now surpassing the 50% mark, meaning that we're seeing the majority of large cap companies are beginning to discuss their usage or adoption or the importance or some type of topic or discussion on AI. And this is telling us that we're going to continue to see more adoption of AI or some more efficiencies within their businesses. Now, on the other chart, we have the share of firms discussing AI's productivity based off the sectors. So here we can get a little more granular view of which parts of the market are really seeing the largest discussion of AI. To no surprise, we're seeing in third is IT, so that's technology, communication services, obviously seeing a big adoption. But it's interesting to see that financials actually are the second highest discussers or potential adopters of AI, really getting some more efficiencies in the AI space. And then we go on down with industrials, healthcare, and so on. So this gives us a little bit of a zoomed in view of where we're going to see some more possible margin expansion, some more productivity, and things like that as AI begins to get used in some of these specific sectors and across the U.S. Market as well. Now I'm going to shift over to Zach, who's going to look at us from a mergers and acquisition viewpoint in the market right now.
Yeah, mergers and acquisitions are one of the key inputs that we take into consideration when we think about performance in the private markets, particularly in private equity and private credit. We refer to that suite that includes a couple other asset classes as Core Plus, which many of you have talked to your advisors about. The chart on your screen here is only showing the mega deals, so those deals that are valued at $10 billion or more. But when you expand the data set out to include all M&A deals, the trend is very, very similar. So what you've seen since 2022, when we entered this high interest rate environment, is that M&A has come down pretty substantially and has stayed that way over the past 3 years. The mechanics of this are pretty straightforward. In order to acquire a company, the buyer typically has to take on a lot of debt in order to do so. And in a high interest rate environment, that debt is much more expensive. You have to pay a lot more interest to carry that debt. So as the debt load has come down, or as the debt expense rather has come down, as we've started to cut interest rates, you've seen M&A activity pick up. Typically when M&A activity is low because of the high interest rate levels, there's not as much demand. And so when there's not much demand, prices are not driven up as much, and you tend to see private equity underperform the other private market asset classes. Private credit, on the flip side, makes their return from issuing these loans. And so because the interest rate on the loans is higher, in high rate environments, private credit tends to be an outperformer. So with interest rates coming down, M&A activity broadly picking up, what we are anticipating and starting to see in the underlying data is that there's more demand for deals, which is reflected in that very large bar on the right-hand side of the screen for 2025. Demand is picking up, prices are starting to appreciate in the private equity market a little bit more, and subsequently the return that these private credit managers are able to make on the loans that they issue is starting to come down. Actually, we've already seen several private credit managers reduce the payout that they are issuing via dividend and income already by 1% or so, in anticipation of rates continuing to fall. And so we've actually made some tactical adjustments in our Core Plus portfolios, the segment of our portfolio that covers the private markets. Throughout 2025, we've much more intentionally allocated to private equity in anticipation of seeing some outperformance by private equity again. And we've started to pull back and become less aggressive in the private credit market, expecting that we may be entering a season where private credit underperforms, coming off of 3 or 4 years of pretty significant outperformance.
All right, thank you, Zach. That's what we have for this week. Next week, we'll be wishing you a very Merry Christmas. We hope you all enjoy the holiday season. If you do have any questions, please do not hesitate to reach out to us. The QR code, the phone number, the website, many available ways for you to get a hold of our office and ask questions or set up a meeting. Thank you so much and have a great week.